Well, let's take a look real fast at some of the pretty much comments from Ripple themselves that they just put out, which align with this redesigning of the token models, right? The tokenomics. So I said every XRP holder should be paying attention to these developments very closely. Um, so I want to transition over into the second portion of today's video breakdown, and I want to first touch on some things in regards to Canton. Play some video clips from an individual gentleman from Signum Bank that go hand in hand with something that Yuval said about how, the utility on the network eventually trickles down to individuals, token holders, right? Token holders, app developers, so on and so forth, and how it just shows that Canton was built with token holders in mind. And that is huge considering the most recent downturn that we've seen. And then I kind of want to transition and show you guys a fundamental piece that Ripple put out on their website just yesterday that kind of goes hand in hand with hopefully them, if they commit themselves to some of the things that they mentioned in the piece themselves. If they commit themselves to some of those developments, it should reflect in greater demand for the digital asset XRP, and then therefore, obviously, of course, trickle down and support the token holders of XRP, the digital asset. So first, obviously, of course, take a look at this. This is the crypto bubbles map, and I have some of my favorite assets in this, and they are on the monthly display. Now, over the last month, okay, this is not AI generated or anything like that. Anybody can go and put this in themselves, and just looking at price action over the last month, over the last 30 days from January 5th to February 5th, the crypto market shed over $1 trillion. Think about that. $1 trillion was wiped from the digital asset ecosystem. And Canton and a few others were still up a substantiating amount, double-digit amounts in terms of percentages across the board compared to the entire rest of the crypto ecosystem. So I said here in this post, what we are seeing in this market right now is a broad risk off move hitting speculative crypto assets. Most public chains and tokens still trade like high beta risk assets driven by leverage, sentiment, and liquidity cycles, not like utility assets driven by real utility and dollars actually flowing through the network. This bloodshed for me was a wake up call. Most people will unfortunately ignore. It shows confirmation that 95% plus of layer ones, some with over a decade of operating experience live in these markets, still aren't being used by institutions at scale. Even though the headlines often make it sound like they are, when liquidity dries up, speculation gets exposed, and only real utility matters. What does real utility mean? Real utility means networks that institutions are actively using for settlement, collateral, and financial infrastructure. And there's a big difference between real utility and assumed utility. How many assets out there, networks out there, are assumed by researchers and the likes of influencers on the internet to be utilized by these institutions? Again, I'd say 95% plus, considering the market downturn that we've just experienced. So, assumed utility means projects that retail investors hope institutions will use someday. There's a big difference, and markets recently reminded everyone of that. Canton Network is fundamentally different, and the screenshot of the monthly gains says it all. Over the last 30 days, from January 5th to February 5th, the total market cap lost over $1 trillion in market value, and Canton was still up 20% during that entire market downturn. This is honestly mind blowing for anyone who actually likes to make money in crypto, because to me, that seems to be like Canton is a safe haven asset in this digital asset ecosystem. What separates strong digital asset networks from purely speculative tokens is whether the technology is designed to bring real value back to token holders through actual usage. Now, digital assets has focused on building the network where the token is connected to real financial activity, settlement, collateral movement, tokenized assets, and institutional workflows. As the network is used for its underlying utility, demand is driven by real transactions and not hype. That means value is created through adoption, integration, and long term usage rather than short term trading cycles. In this model, token holders benefit as the ecosystem grows because the network's purpose is to move real capital and solve real problems, not just exist as a speculative asset. I want everybody to remember about the dot-com bubble, how it had winners and losers. And everybody needs to realize that crypto will as well. Now, I'm not sitting here saying that Canton coin is the chosen one by any means, because I'm well diversified. I actually hold most of the assets in the picture in my portfolio, i.e., this picture here. And I still hold a long term bullish perspective when trading activity flips back risk on. I'm just here to show you all the current data, and the current data is speaking to you. Whether or not you choose to listen is entirely up to you. And so here are just the screenshots to show physical proof that the market shed from January 5th to February 5th over $1 trillion. And this is literally mind blowing because you know how many people say that Bitcoin is a safe haven asset? I honestly fully believe that this pullback showed to some extent that embedded in crypto out of the layer ones that exist, Bitcoin did not act as a safe haven asset in this most recent market turmoil at all whatsoever. Whereas Canton token, had you have had your money in Canton token during this last 30-day downturn, your value in your portfolio would have actually sustained itself, and if not, made you money. From January 5th to February 5th, Canton's price held over 24%. That is massive. Then if you look at the valuations on the monthly over the last month, right? Canton is still up 29% comparative to all these other assets. Now, I'm not crapping on all these other assets. Like I said, I hold a large portion of a lot of these other assets in my portfolio. But this to me, as an investor who actually likes to make money and preserve my wealth, was a massive wake-up call. So why am I reading this to you guys? And how is this going to trickle down into something that Ripple just recently announced? Okay. Coming over here to a panel discussion from Signum that took place just yesterday, February 5th, live streamed, the chief investment officer at Signum, Fabian Dori, said something very particular. So shout out to Signum for this. You guys can go watch this yourselves. Shout out to the CYPRX researchers for sharing this in the private CYPRX Discord. Think about this, guys and gals. How much information did we show you all here at CYPRX that nobody has seen? This particular video has 16 views. 16. 16 people have seen this. Mind-blowing to me that there are billions of people on this planet and millions of people in crypto, and nobody's actually watching what the banks are saying. So listen to what Fabian from Signum, who is a large market participant in the crypto ecosystem, a Swiss bank, and listen to what he says about how people should be focused on networks that actually drive utility, and the utility then trickles down into the token holders. Listen to what he says here.
Provide a certain floor on the drawdown side. But then also the on-chain activity, which is still growing, very much driven by stablecoin adoption, tokenization, and also tokenization of stocks and other financial assets, which is clearly progressing. And then also staking frameworks that are much clearer, bringing assets on-chain. I think what also speaks for an improvement is the fact that many protocols are reviewing their tokenomic models and redesigning them in a way, or trying to redesign them in a way which brings true value accrual to the token holders. For example, by generating real revenue, which is then brought to the token holders in form of token burns, instead of just pure inflation, which is currently seen quite negatively. What is also an interesting indicator to follow are exchange reserves, which are at.
Okay, so what Fabian just said is that a lot of protocols are going to start to redesign their token models, right? So that way the value that accrues on the network actually trickles down to the token holders through burns, right? So on and so forth. Think about that. This is coming from Signum. Then once again, keep this in the back of your mind when we read this fundamental piece from Ripple that they just put out, because this aligns with that redesign mechanism that Fabian just mentioned, okay? But I first want to play a video clip from Yuval Ruse to show you guys why Canton's price looks like this compared to the rest of the market. So that way you guys don't sit here and say that I'm hyping Canton coin or anything like that. I'm not shilling it to you guys. You can invest in it or not. But considering what the gentleman from Signum just mentioned, Canton is already 10,000 steps ahead of every other project, because right now they're one of the only projects that has already designed their tokenomics for this exact environment, right? This is crazy. So listen specifically to what Yuval Ruse says here from Canton Network. Shout out to the Milk Road for this podcast. It was put out 2 days ago. You guys can go check it out over on the Milk Road YouTube and just listen to what Yuval Ruse says here and how this aligns with exactly what the gentleman from Signum just said.
Very quickly and easy to understand for people like me, what exactly is Canton and what problem are you solving for these institutions that's making them sign on with you?
Sure. So you maybe we should start from a point you made in your introduction, which I think we'll probably discuss in more detail later on, which is, you said Canton has been the only thing that has been green for the last week or so. And maybe another one that is worth highlighting is Hyperliquid. And what's unique about the two things, which is, I think that one of the things that I found very compelling when I got into this space a long time ago was this idea that crypto pitched itself as a way for everybody to own a piece of infrastructure that actually generates utility for the world. And the reality is that I think that, us as an industry have done a lot of great things in terms of proliferating the technology, explaining why this technology is important. But when you end up thinking about most of the tokens that have been launched or the ones that are already still in existence, not a lot of value gets accrued to the token holders. And, for us, one important thing, and we'll talk about how we did that, was to make sure that whatever success we have on Canton, whatever utility we drive on Canton, that value needs to mechanically flow down to the token holders. Now,
so word for word, exactly what this gentleman here from Signum just said yesterday, only has 16 views, mind you, again. So think about that, which is exactly why Canton's price, comparative to all these other assets, you can't make this screenshot up. It's the data is right here. This is physical proof that what Yuval said is actually happening in real time. And I had the pleasure to actually speak to Yuval on a podcast the other day. You guys can go over to Yuval Ruse's Twitter profile and you can listen to this live stream and listen to what Yuval Ruse says at about 23 minutes into this podcast, where he talks about how 95% plus of the digital asset landscape is just speculative trading. And people are starting to wake up and realize, oh crap, I actually need to start to rotate into real utility. Listen to what he says here.
Canton coin hit a new all-time high, and it was an interesting screenshot that I shared earlier today, where the rest of the market was relatively down comparative to Canton coin's price action. We actually, I believe, jumped into the number 15 spot, surpassing Chainlink. Not that this is a competition by any means, but it brings me back to something that in a recent podcast, Eric, the co-founder, said. In particular, he specifically mentioned that we could see a scenario where we see sideways to downwards price action as kind of like a macro backdrop in the digital asset ecosystem or the risk-off spectrum, and that Canton could continue to burn through it. And we could see an anti-correlation with the macro kind of risk-off spectrum, because as we continue to drive more utility into the ecosystem, it generates more burn. Could you all kind of expand on that and go into some details on why you all chose to implement this burn and mint equilibrium and kind of compare it to some things that you've seen in the space over the last decade, without naming any names or particular chains, but just kind of go into detail on that a little bit?
Oh, really? You see, I was about to give you a name of a chain.
Okay. I mean, yeah, if you want to name some chains, sure. If you want to piss some people off.
because I think Charles from Cardano was giving me a hard time. I mean, listen, I think that what you're seeing in the market is that it's almost like bots and users are effectively just reacting, and which makes sense, by the way. But you have chains that are static, where the transactions don't burn coins, the supply is fixed. They did a pre-mine, they did something like that, and you end up realizing that mechanism means that the value of the coin, the value of the network, is pure speculation. Right? There's networks that have, if you actually calculate the dollar volume, the dollar value that gets processed on those chains, and the market cap of those chains, we're talking about, in some cases, thousands of multiple. That is not rational, right? That's just, sometimes I'll say on podcasts that crypto have defied the laws of gravity for way too long. And the reality is that what you're seeing, I would say, generally speaking, is that, you know, Bitcoin sells, Ethereum sells, and everybody is just correlated to that, right? So maybe the way to think about it is like in equity markets, or in just generally speaking markets, there's what you call high beta assets, so more risky asset. So if you think about large cap are the most safe assets, small cap are the high risk assets. So small caps are a high beta asset. If the market sells off, you expect that small caps will just sell off harder. If the market rallies, you expect small cap to rally harder. It's just how it is. So kind of similarly speaking, what we're seeing here is that there's nothing fundamental happening other than Bitcoin and Ethereum. And that's just generally speaking, there's a risk off. And therefore you're seeing that all of the alts are getting decimated as a result of that. But I gave an example of hyperliquid, and we'll talk about Canton. At the end of the day, if the mechanism of your chain is saying, listen, if utility grows, the chain will be less inflationary, or in some cases even deflationary, that's just going to go contra. Now, I think that when you look at the volume of Canton, you know, it's very low. And, you know, we as a foundation, me, myself, can't even tell you how many people approach us to generate volume on the network. And we always refuse. We want the volume to grow, but it needs to be organic. It needs to be real volume. So I think what you're seeing is that the people that are focused on Canton are the people that are actually not looking at like macro and don't just like sell. I'm not going to say, I mean, there was someone just, you know, sold in the last, you know, hour or so, did a big sell. But I think generally speaking, what you're seeing is that people are rotating, in my opinion, into where there's high utility. That's what I think you are actually seeing. And that's why I think it's a contra to what is happening, is you're just saying people are saying, okay, well, I need to risk off. What do I rotate in? And I either rotate into cash or I rotate into things that I think are just safer.
Yeah, safe haven.
Let me ask you a quick question to just make sure I understood what I heard. He said that he's been approached to bring basically not organic volume to chain, and he's refused.
Yeah.
Now, with that being said, if he's been approached to bring inorganic volume to his chain,
What do you think all the other chains have been doing?
exactly.
Bingo,
And what did they,
baby.
what did they say yes to when? And why, matter of fact, why is he the only one I'm actually heard this from?
Bro, I'm
Really?
telling you, this screenshot, I cannot stress enough that I hold, again, most of these assets in my portfolio that you're seeing on the screen. But there's a wake up call, y'all. This screenshot over the last 30 days is a wake up call.
Yeah.
In crypto. Now, because again, you know, we got a bunch of split community members. Some of you guys hold Canton, some of you guys don't. Most of the people that follow myself and Aqua probably invest in this one digital asset here, XRP. Okay. So remember, I want to present the hopeful, right, forward-looking mindset, because remember this gentleman Fabian, he did mention that most layer ones are about to start to transition and redesign. He specifically said redesign their tokenomics, their tokenomic models to fit exactly what Yuval Ruz just mentioned Canton already does. So there is hope for these other layer ones if they can redesign their token model to do exactly this. And if not, then we're most likely going to continue to get dumped on every time that there's a risk off market sentiment. Now, with that in mind, I said here in this post to you guys, but yeah, Aqua, you're spot on, bro, with that speculation. I think that if Yuval has been approached to pretty much present fake volume on the network, what do you think all these other chains have done? You know?
Exactly.
I said here in this post, every XRP holder should be paying attention to these developments very closely. And so now, because this popped off, got 50,000 impressions, let me explain why, so you guys have a little bit more context after listening to the gentleman Fabian from Signum, Yuval Ruz, and now after looking at the freaking decimation in the crypto market and how Hype and Canton are two of the only projects that actually fit this burn model in their tokenomics that then trickles down to the token holders because of the underlying utility actually driven through the network, burning the underlying token. Well, let's take a look real fast at some of the pretty much comments from Ripple themselves that they just put out, which align with this redesigning of the token models, right? The tokenomics. So I said every XRP holder should be paying attention to these developments very closely. Let's read this. All right. So we'll go over to the Ripple website. You guys can go check this out yourself. They dropped this just yesterday, February 5th, 2026. I'd go outright and say that if they don't commit themselves to these things, to these announcements and to these developments, it should be very concerning in my personal opinion. I'm going to be holding them accountable to this and paying attention very closely to some of the developments that are, according to them, coming soon. Okay. Because if they don't, again, it's a case for concern how, remember I mentioned that all these networks are constantly saying utility this, utility that, but actually in reality, they're just speculatively traded right now in the moment. There is no underlying utility flowing through the network at scale right now. And this picture says it all. You can't make that up. That's not me speculating. That's me showing you guys the facts. And the facts is that the underlying utility on these networks that claim that they have underlying utility flowing through the networks isn't actually happening at scale like they are saying. And instead, they're just speculatively day traded with over leveraged hype. And this market correction, like I said, was a wake up call to that reality. Now, I'm hoping that in the future, the vast majority of these digital assets, whom in which most of you guys probably hold in your portfolio as well, actually transition and are actually adopted at scale by these financial institutions and these enterprises and so on and so forth, which I do, by the way, think is going to happen. But right now, we have to come to terms with the fact that it is not, right? And hopefully have a forward outlook that it will. But again, like I said, we need to hold accountable claims like this from Ripple themselves that this is going to happen. So back to the redesign. All right, let's read this. From feature set to financial infrastructure, because this aligns with what Fabian said, that layer ones are starting to redesign their tokenomics to, again, hopefully reflect the price and the demand of said digital asset by actually burning said digital asset via the driven utility on the network. So the XRP ledger has evolved into a high-performance blockchain for tokenized finance with compliance tooling, real-time settlement, and asset layer programmability, now live on mainnet. In parallel, XRP, the native digital asset powering the network, has seen a surge in both direct and indirect utility. You would think that if it's seen a surge in direct utility, that the price would reflect that utility. You have to ask yourself the question why it is not. Again, I'm not speculating. I'm here just showing you proof that if demand is surging on the network, why is the price not surging? Okay. There's a reason for that. I'm not here to debate what that reason is. I'm just here to show you guys the proof. This latest institutional DeFi update lays out how core features are being adopted, how XRP is used to facilitate key institutional workflows, and where the roadmap is headed next. With native on-chain privacy, permission markets, and institutional lending set to go live in the coming months. So here it says in the coming months, we need to hold them accountable for that. Let's see if that actually happens, right? I'll be paying very close attention, and I hope to God it does, because XRP is still my biggest bag, right? XRPL is positioning itself not just as a chain for tokenization, but as an end-to-end operating system for real-world finance. At the heart of every institutional use case is XRP. Its impact spans both direct and indirect roles. The direct impact is underlined by new features that drive transaction volume and attract asset issuance to the XRPL, increasing demand for network resources and therefore XRP. So this is great. Again, that aligns with what Fabian said, that a lot of layer ones are going to start to redesign their tokenomic models. The indirect impact we can also hone in on comes through how XRP is used in base layer operations like reserve requirements, transaction fees, and I highlighted in green, it says resulting in burning XRP and bridging currency and FX and lending flows. Because what did Fabian say? He specifically mentioned the tokenomics and the utility of the network resulting in a burn of the underlying digital asset. So let's hope that this really does take place, because it will most likely create a surge in demand for XRP if it does, which I'm hoping it does. Payments and FX, fast, compliant, and liquid. XRPL's heritage and payments continues to mature with new infrastructure upgrades. Down here, it mentions permission domains, permission DEX, stablecoins on the XRPL. XRP impact. Every transaction, particularly in the PDEX environments, burns XRP. These flows increase as stablecoins and FX corridors deepen on the XRPL. In the XRP use case, it says in the PDEX environments, XRP acts as the auto bridge asset in FX and remittances, settling trades between stablecoins and other tokens instantly and with fee efficiency. Then here it mentions unlocking the balance sheet. Institutions are exploring XRP for collateral optimization and capital velocity, supported by token escrow, batch transactions, and MPT or multi-purpose tokens. The XRP impact is that MPT's escrow and settlement workflows increase network usage, which would be good, especially if increased network usage does what? Burns XRP, right? and requires object reserves and transaction fees all denominated in XRP. Use cases: asset managers deploying tokenized money market funds or high-grade collateral uses on the XRPL for issuance, escrow, and delivery versus payment, all involving XRP at the protocol layer. Then down here, it mentions credit financing. The XLS66 lending protocol enables fixed-term underwritten loans with repayment automation, which is cool. XRP and lending, where XRP can both be borrowed and lent. It's also the default bridge asset in FX flows and settlement. Evernorth says here is actively preparing, doesn't say it's happening yet, which is a good key vocabulary word, which is why I highlighted in green. Evernorth is preparing to utilize the lending protocol to generate institutional grade yield on its extensive XRP holdings. Today, we are thrilled to announce Evernorth's intent to utilize the upcoming XRP lending protocol as a core pillar of our digital asset strategy. That is coming from Sagar Shah, the chief business officer at Evernorth. And then he mentions that this will unlock major yield opportunities for the XRP community. So this was such a great post. And if you come down here, it just talks about some things that are coming soon, which again, I mentioned every XRP holder should be paying very close attention to. Okay. Confidential transfers for MPTs, enabling institutional grade privacy on the XRPL by encryption, transaction amounts, and balances using zero knowledge proofs. That's huge because we know institutions need privacy capabilities in order to really scale on these layer ones. But nonetheless, okay, it just goes to show that Ripple and the XRPL, they're kind of waking up to this whole nomenclature of the redesigning of the tokenomics model, that once the underlying utility actually scales, it should result in burn of the XRP, said, then transforming into demand for the XRP token, which will then trickle down into, obviously, of course, supporting the underlying token holders of XRP. So hopefully this kind of presentation and this release from Ripple themselves shows you guys that all of this is in the works, okay, which is why I'm still optimistic that it could possibly happen. But this just goes to show that it's only really happening right now on a few layer ones, not all of them. Okay. So wake up call, because if this does not change on layer ones moving forward, again, diversification and shifting allocations in certain projects based on how they transform in the future moving forward is of key importance, and not marrying a bias if these layer ones cannot transition and actually allow the value on the network, the utility of the network, to reflect itself and trickle down to value for the actual token holders. Kind of catch my drift there? So hopefully that makes sense to you guys. I hope that playing physical videos from actual representatives from banks helped you guys kind of understand that this shift is happening and it's taking place in real time, and showing you guys that CANTON has already been focused on this for over a decade now, and it is reflecting in real time. Hopefully more layer ones can do the same thing, especially considering that a lot of us have invested our hard-earned money into these projects. And I'm assuming, just like myself, you guys are tired of getting dumped on because the utility that flows to the network doesn't actually trickle down and support or benefit the underlying token holder. Okay. So again, I'm super bullish on XRP if they can pull these things off that they've mentioned in their own documents, but I will be paying very close attention to these developments in the coming months ahead. As they've stated themselves, all of these things are set to take place in the coming months.